right, so we are on to our last chapter here, corporate taxation. And in here we're talking about two different, well, we're talking mainly about one type of corporate organization, but we touch a little bit on another type of corporate organization. There are two types of corporate organization. Actually, there's more. There's nonprofit as well. Nonprofits are technically corporations, but we don't talk about nonprofits in this class. But we have C Corps. Oh, I used the wrong. Oh, I guess that's all right. We'll see if that works. Okay. So we have C Corps and we have S Corps. We're mainly going to focus on the tax rules for C corporations. We'll talk a little bit about S corporations. S corporations are kind of a funny hybrid between partnership and C corporation. S corporations are generally small corporations, like kind of mom and pop corporations. Used to be a really popular form of corporate entity. With the tax changes that took place in 2017, it's not quite as popular as it used to be, but there's still a lot of S corporations out there. In fact, that was the most common, so when I was practicing, I did just hundreds and hundreds of individual tax returns. But second, as far as quantity, were S corp returns. Did quite a few S corp returns. Next would probably be partnerships, and then C corporation returns. Didn't do quite so many. I personally didn't do quite so many of those. A lot of times the corporations will go to bigger accounting firms, and I worked for a relatively small accounting firm for the corporate taxation. I don't know why they do that. Maybe they figure they're getting more specialization, but corporations really aren't that difficult. They're actually, in a lot of ways, they're easier returns than, they can be easier returns than individuals, because individual returns, as you know, there are a lot of little pieces to them, a lot of different credits, a lot of different deductions. There don't seem to be quite so many of those with corporate returns. But so we just kind of look at them from, again, kind of like we did with the partnerships. In this class, we're just going to look at them from the 30,000 foot level, kind of hit the main points of corporate tax returns, what makes them different from individual returns. And like I said, we spend most of our time talking about these C corp returns. S corp returns, we don't, we just have one section at the very end where we talk about S corporations. The form that C corps use is called 1120. Sorry, this marker isn't very good. S corps use an 1120S. S corps are another type of pass-through entity. So with any of those other pass-through entities, we're talking about K1s. So K1s are issued with to the owners of S corporations. C corporations, though, are not pass-through entities. It means they pay tax. The C corps themselves do pay tax, and what's lovely about C corps, and something that makes them, that adds to their simplicity, is they just have one tax rate, 21%. That's it. It's a flat tax rate for corporations. Didn't used to be that way. That changed. Again, that was one of the big changes in 2017 with the tax bill, was the tax rate. It used to be a marginal. They used to have a marginal tax rate system as well, and it was graduated just like with the individuals. So it started at like 15%, went all the way up to 35%. So depending upon what your income was, but now it's just a flat 21% tax rate for C corporations. S corporations, because they're a pass-through entity, the income from those is going to be assessed whatever the tax rate is for the owner of the S corporation. So, but like I said, we're mostly going to talk about these C corporations here. We're going to talk about how how they're formed, what the filing requirements are. A lot of the filing requirements are very depending upon the state that the corporation does business in. So I'll pull up the Iowa Secretary of State site and just kind of show you some of the corporate filing, show you what some of those forms are for formation of a C corporation. We're going to talk about basis again. Now, yay, great thing here is basis is a lot easier to calculate and to discuss with regard to C corporations. S corporations are weird, just like partnerships. Their basis calculation is a bit different, but the good news for us is we don't really get into that very much in this chapter. We're just mainly going to talk about C corporations, but we do have to talk about basis, and there is still inside and outside basis for C corporations and their owners. But like I said, it's a much easier discussion to have. Then we're going to talk about taxable income and tax liability, calculating that tax liability. Tax rules for transactions with shareholders, when shareholders receive dividends or distributions, what the tax effect is for shareholders and for the corporation. This is probably, these two sections are probably the most intense. So Schedule L is just a balance sheet. Schedule M1 and M3, we really don't get into to preparing an M3. M3s are, we just kind of explain what the M3 is. M1 is calculating the book tax differences. So I kind of gave you a little preview to that. With partnerships, there's an M1 as well. You've got to go from what your net income per books is to what your net income for tax purposes is. So, and because the rules for financial accounting oftentimes differ from the rules for tax accounting, we've got to go through different steps to get from point A to point Z there. So this is probably the most complex part of this chapter is this M1. Also, some other corporate issues. There are some special rules with regard to percentages of ownership for corporations. We talk about parent-subsidiary relationships and brother-sister relationships. So, and we'll get into those details when we get there, but that's what they're talking about. So these two sections are probably the more unusual, I guess, to talk about, more complex. And then this little section here about the rules for S corporations is what we're going to finish with. Get started.